Are you ready to avoid the common pitfalls of investing and increase your chances of success? Find out the 10 mistakes every single investor makes and how to avoid them with the help of, you know, the big guy, not Santa Claus, Warren Buffett's advice. So in this video, I'm going to give you my take on his wisdom and on one of the most successful investors of all time. And when you watch till the end, you're going to know how to start implementing these methods for ultimate success. So mistake number 1. Buying high and selling low. This sounds cliche. I know you're thinking about it. You're thinking, oh, well, who would buy high and sell low? Most people do. They do because they get caught up in the euphoria, the FOMO of buying high. When everything's going up, that's when they want to buy. And then when everything falls down and starts falling apart and they're losing money, they see the red, they emotionally get charged and they sell. That's how you buy high and sell low. It's the opposite of what you should do. This is one of the most common mistakes investors make. They buy assets when the prices are high and they sell them when the prices are low. Warren Buffett advises investors to be patient and avoid trying to time the market. You can't time the market. You'll never get it right. The best in the business can't time the market. So what makes you think you can do it? You're never going to get the top and you're never going to get the bottom. So why are you trying to constantly do that? So just follow the simple rules. Buy low, sell high, and don't lose money. Stop buying in to FOMO and market euphoria and thinking you're missing out, which forces you to buy high. And then what do? You get scared when it all falls apart and you buy low. Warren Buffett would definitely not approve of that. Here's the second mistake. Failure to diversify. This is another mistake a lot of investors make is they don't diversify. They think they find their golden goose and they go all in on their golden goose. And they have zero diversification in their portfolio or limited diversification. Now, this is going to increase your risk of loss tremendously. Warren Buffett advises investors to diversify their investments, spread out the risk. This is what he does with Berkshire Hathaway. He diversifies his portfolio. And I will be very clear about one thing though. Warren Buffett, he invests in things that he knows, likes, and understands. And you should do the same thing. So if you're going to diversify your portfolio, do it by investing in things that you understand. Things that you know, like, and understand will certainly help reduce those risks. All right, mistake number 3, chasing hot stocks. Come on. You know you've done this. I've done this. Some investors may be tempted to chase stocks because they're the latest hot stock. They watch something on the news. They see Kramer, who's wrong more than he's right, but they see Kramer talking about the newest hot stock and they dive in. This is a risky strategy. Warren Buffett advises investors to focus on long-term investment strategies, and that will avoid chasing the short-term gains and the winner. If you follow the winner, you're going to be the loser. That's all I can say to that. All right, mistake number 4. Not having a clear investment plan. I say this all the time. Without a clear investment plan, investors make impulse decisions. They make emotionally charged decisions that don't align with their long-term goals in any way, shape, or form. Warren Buffett advises investors to have a clear investment plan and stick to it over time. If this is your plan, stick to it. Come up with your own set of rules. Come up with how you want your investment plan to look like, and don't stray from it. Warren Buffett, come on, if you're going to take advice from someone and you're going to look at it, Warren Buffett's the guy to follow. Mistake number 5, not considering the quality of the business. Listen, I'm not going to throw any of you under the bus, but how many of you invested in Bitcoin? How many of you invested in Ethereum? How about those crap coins, those meme coins, and all those other things? Did you really look at the quality of those businesses? Was there even any fundamentals or any intrinsic value? There wasn't. That's why Warren Buffett doesn't like crypto. Some investors may focus solely on the financial metrics. This is Warren Buffett. He looks at the fundamentals of a company and not considering the underlying quality of the business. Well, that's a huge mistake. And Warren Buffett advises investors to focus on the quality of business and on the fundamentals, and to really consider factors such as the company's management, competitive advantages, and growth potential. Not just what the Uber driver or the Lyft driver said is going to be the next one that's going to go to the moon. Come on, we're not in 1929 right now. Or actually, feel like we are. The investor sentiment's exactly the same. People are making decisions that make no sense, and they're making FOMO decisions, fear of missing out decisions. They're not looking at fundamentals, and you're probably not either. So just listen to Warren Buffett. Get back to the basics. Mistake number 6, not understanding the risks of an investment. Again, I just mentioned crypto. Most people didn't understand the risks in that until all of a sudden they lost most of their money. See, failing to understand the risks of an investment can lead you to unexpected losses, and more than likely will lead you to unexpected losses. Warren Buffett advises investors to carefully consider the risks of an investment, to really analyze the risks, and to make sure that they're within the risk-reward profile of what the client wants. Because if you don't, you're going to have potential for losses that is far higher than you want it to be. Mistake number 7, not having a long-term perspective. I mean, Warren Buffett's the perfect person to look at this. I'm not always the best person to look at the long-term perspective. I like short-term investing, but I do it strategically. So for the general masses, not having a long-term perspective is a big mistake, because short-term thinking can lead to impulsive decisions that don't align with your long-term investment goals. See how we're linking all these things together? Warren Buffett advises investors to think long-term and to be patient in their returns. I just did a YouTube video, and it really talked about a study done. And it was a study done about investors doing exactly this, thinking long-term, being patient with their investments. And the investors that held their investments for 5 years versus a year or less, they had I can't remember, I think it was an 18% increase in their returns. And I might have those percentages wrong, but it was a dramatic difference between 1 year and 5 years. That's just patience, folks. If you want to make money, you're going to have to get patient. Number 8, this is definitely a big mistake. Not considering the cost of ownership. So let me explain. Some investors may not consider the ongoing cost of ownership, such as fees and taxes, when making investment decisions. They just blindly invest in things, not thinking, well, what are the costs of this moving on? How much are they charging me in fees? What are my taxes going to be? A lot of mutual fund investing is exactly this. They don't factor in any of that. They look at the average rate of return, which is really just a fake made up number in most cases. If I showed you what an average return is, you'd understand. So when making investment decisions, Warren Buffett advises investors to consider the full cost of ownership when evaluating an investment. So Warren might go a lot deeper into that than you are, but you should start reading the prospectuses. At least read the fact sheets on the investment. What are the fees? What is this going to cost me? If I got to get out of this, is there a back-end charge? Is there illiquid investments that I put my money in that I can't get my money out of? All those things are a major consideration, and taxes. You buy something and you sell it and then you buy it again. Well, now you got taxes on the gains. And these are important things to factor into your overall planning. So number 9 on the list of mistakes, not considering the opportunity cost is what this one is. So investors may make the mistake of not considering the opportunity cost of an investment or the potential returns that they could have earned by investing in a different asset. So what Warren Buffett advises is that investors consider the opportunity cost of each and every single investment. If you don't understand what opportunity cost is, then Google it. It'll tell you everything you need to know. And the last on the list, this is the 10th mistake, is not reviewing or adjusting your investments. So failing to review or adjust investments can lead to a portfolio that's not aligned with the investor's goals and with the investor's risk tolerance. Warren Buffett advises investors to periodically review their investments, make adjustments as necessary. And here's the thing I'll throw in there. It's called, you can continue to keep investing in something, but you should rebalance it. For example, if you've got an investment and you got 20% here, 20% here, 20% here, 20% here, over time, you're going to get out of whack. The risky one in bull markets, like what we just got done with, might be now 50% of your portfolio, where the more conservative ones might only be 10%. So what you'd want to do is rebalance, sell the high and buy the low to bring you back up to your original investment objectives. You see, there's a lot to investing, but none of it's all that complicated. You just got to stay on top of it. You got to review it. If you like this video, check this one out. Should I pay off my mortgage or should I invest that money? It's a React video that I think you'll really enjoy. Thanks for joining me today. See you on the next one.